What's going on, guys? I'm going to show you how to get into the stock market in 2021 without being scared that you might lose it all because markets are so high right now. So stick around. What's going on, everyone? I'm Gagan. I'm not a financial advisor, so everything I say in this video is for entertainment purposes only and not to be taken as financial advice. So today I'm going to show you guys how to get into the stock market in 2021. But if you don't already have an investment account open, then definitely go check out my video because I tell you guys which accounts to open and which platforms are the best to use. And I'll try to link it for you guys right up here if I remember. But if you guys already have your accounts open, then let's get started. So this investment strategy helps us get into the market with reducing the amount of volatility. And if you guys don't know, volatility is when something is changing very quickly. So like when stock prices go up very quickly and down as well, and unpredictably. And if you're scared to get into the market right now because prices are so high, I completely agree with you. The market is at an all-time high, but the economy isn't actually a lot better than it was a year ago. Let's just take a look at the S&P 500 index to show you guys. And if you guys don't know what that is, it's an index that tracks 500 large companies in the United States. So by looking at this figure, we get a general idea of how the overall market and the economy are doing. So this is the S&P 500 index. And by looking at the 1-year chart, we can see during the COVID market crash, it came down to about 2237, and it seems to have recovered a lot better and quicker. And by looking at, let's say, the 3-year chart, we can see that it's a gradual increase that by investing in stocks, eventually if you are willing to hold long term, it's almost guaranteed that you'll make money. By looking at the 5-year chart, we can see that it started off at 1940 in 2016 and now it's at 3800. So yeah, the economy might not be a lot better than it was a year ago, but a lot of these companies in that 1 year have adapted so well by reducing their workforce, being a lot more efficient, using different softwares, learning where to cut costs and where to actually grow your revenue. A lot of companies are doing a lot better and they're making a lot more revenue, which means that the S&P 500 index will in turn be a lot higher. So by expanding the chart a little bit more, we can see that in 2000 it was at its high, and during the internet bubble it crashed and came back down. But then it came back up, and in 2008 during the financial crisis it crashed again. But it came back up. And now during the COVID crisis it crashed again and it came back up again. So if you're willing to actually leave your investments here, you shouldn't be very scared, but you just need to know when you need to pull your money out and how long you can actually leave your money in there. So if you're scared looking at this chart and investing right now, that's completely normal, and that's exactly what I thought when I started investing many years ago. But sometimes you have to be a little bit scared and you have to be willing to jump right in and actually do it yourself to learn. And there are strategies that you guys can use to minimize your risk that we will talk about right now. So by using this, we can remove the work of trying to get into the market at a perfect time because it's impossible to time the market. We do this by making purchases regularly, and we don't buy everything all at once. So first, you need to know what stock you want to buy, how much money you want to put into the stock, how much in total. I don't mean all at once. I mean, if I want to buy, for example, like the NEO stock, and I want an overall position of $10,000 in, that's what I need to know. Not how much I have today and how much money I can put into the stock today. Even though you might not have 10,000 today, if you can earn that 10,000 within a month or 2 months or a year, that's okay. You just need to know the overall position that you want to hold in that company. So with this strategy, we buy it periodically. And what that does is it either brings our average a little bit lower or it increases our average. But when the stock is falling, it helps us minimize our losses. And when the stock is going up, it helps us gain a little bit more. So let me show you with an example. We'll look at the Palantir stock right now. It's one that's very hot in the market and one I own as well. But I don't suggest that you buy it unless you guys do your own due diligence on the stock. So let's say we started investing just 3 months ago and we want to put $1,000 into the stock market each month. Let's say we started buying the Palantir stock on November 1st. So November 1st, the price was about $10.54, and if we put $1,000 in, we're able to buy 94 shares. On December 1st, the stock price was $22.51, right around here, and we were able to buy 44 shares. And let's say we did this in January as well. In January, the stock price was about $23.37, right around here, and we were able to buy 42 shares. So total, we have 180 shares with a cost of $16.23. This is called dollar cost averaging. So we put in a total of 2,900, and right now, if we look at the share price, it spiked 25% just yesterday actually. So we would have a profit of $2,943 with our average share price of $16. This is what dollar cost averaging is. By slowly buying more and more shares, you avoid the volatility in the market, and you eventually either increase your average share price, but you own more shares as the price is going up, or if the stock price is going down, then you lower your average, which is still a good thing as well. So yeah, you might be thinking, if I had just dumped all my money in the very first day, I could have made more money. Yeah, that is the case, but let's look at a few other companies. Let's look at Sarepta Therapeutics. And this is not a small company, keep in mind, they're not a penny stock. They're worth $7 billion right now. And if we kept the same process by investing $1,000 each month starting in November, the share price was about $137, and we'd have 7 shares. December 1st, we would have 6 shares if we did the same thing. And January 1st, we'd have another 6 shares again. So in total, we'd have 19 shares. That would cost an average of $150. So by looking at this chart right now, yeah, we would have a decent gain looking at the share price of 170, but it just recently tanked over 50%. So right now, the share price is $98.24. So you would be at a loss of around $983. But you're gonna buy more coming February 1st, and most likely the share price is going to be a lot lower than your average, which will just bring your average even lower. So the most important thing is, don't panic sell, control your emotions, and if you look into a company good enough and you do your research and you actually like the company and you think it's going to grow in 5 years, then you shouldn't be worrying about selling anyways. If you guys actually look at why this company dropped so much, it was because it had negative outcomes for its drug trials. They were trying to release a drug for muscular dystrophy, and I believe that that trial did not come out as good as they had expected, but it lost $7 billion, even though it has so many other products that are still going to earn a lot more revenue. They have so many other products that they're still bringing into the market. So in 5 years, if you think the company will be in a better position, most likely the stock price will be in a better position as well. I don't have a position in this company, but after doing the research, it's pretty clear that investors overreacted. And if you guys look at the first day that the share price fell, it fell to about $82 and it's already back at 98. That's almost a 20% increase. So I'm going to give you guys 3 reasons why I believe that everyone should be using this investment strategy, which is dollar cost averaging. So the first one, in 2021, the markets have been very uncertain, and a lot of it doesn't make any sense. And there's a lot of volatility. And this method eliminates the need to ask yourself the question like, oh, I don't know, the stock price seems very high right now. Is it the right time to buy? Well, it doesn't matter because you're going to buy more if it falls and you're going to buy more if it goes up. So that's the first one. Number 2, it takes all the emotional factors out of the investment decision. If the price goes up like crazy, it doesn't matter because you're still making money. And if it goes down, it doesn't matter as well because you're going to lower your average cost anyways, which will help you earn a profit a little bit quicker because your average price is a little bit lower. So that's number 2. And number 3, not everyone has a huge pile of cash just sitting in their savings account. So by doing this monthly or even every 2 weeks, whatever period you guys decide, it just helps you build a position in the market a little bit easier, and it's a little bit easier to diversify this way as well if you guys don't just dump all your cash into the one stock the very first day. So if you guys like this video, go on and hit the subscribe button down below, give it a thumbs up. If you guys want me talking about anything else, say it in the comments below, and like always, I'll see you guys next week.